and issues that are significant enough to impact an organization's governance, reputation, and ability to meet its strategic objectives. Those of you who have studied the financial audit will recall that the way we apply materiality in a financial audit is not the same as we apply materiality in the governance and compliance audit. I've said it differs significantly from its application in a financial audit. So then, what is materiality in a governance and compliance audit? That's a very important question for us to answer before we get into the key factors for determining materiality at the planning stage while conducting a governance and compliance audit. So I come back to the question. What is materiality in a governance and compliance audit? Now, materiality in a compliance context is the threshold at which an issue of non-compliance or a control weakness or a governance failure is considered important enough to warrant attention or remediation or even reporting to senior management and the board. That is to mean that materiality in this context is the measure of what truly matters to the organization's stakeholders, including regulators, customers, employees, shareholders, name them. And a minor one-off deviation from an internal procedure might be immaterial, but a systematic failure to comply with a key regulation could lead to a massive fine or massive reputational damage, which is highly material. You understand that example, candidates? That a minor one-off deviation from an internal procedure, because an organization is required to adhere to internal policies or procedures and also external laws. So a minor omission to comply with an internal procedure or policy could, in a way, be immaterial, not critical or not important. But if there is a systematic failure to comply with the key regulation, it could be applying certain regulation or industry-specific regulations or any other form of regulation by the government, that could lead to, that could be highly material. It could lead to reputational damage, which could be highly material, and so on. So that is the meaning of materiality in the context of governance and compliance audit. So in this lesson, having understood the meaning, let's identify the key factors for determining materiality. Key factors for determining materiality. What are the key factors that determine materiality? Now, these key factors, we can categorize them into two: the qualitative factors and quantitative factors. We may have and these are the most important factors in the context of governance and compliance audit. Quantitative factors. These are the most important factors. Now, qualitative factors are often the primary drivers of materiality in a compliance audit. And these are non-monetary elements that can have a significant impact on the organization. One such factor, this is 1A, is Legal and regulatory impact. Legal and regulatory impact. This is the most critical factor, because a single instance of non-compliance with the law or regulation can be highly material regardless of its financial cost. And the potential for fines, lawsuits, or regulatory sanctions make legal and regulatory impact a priority. It makes it a top priority. Here we are talking about non-compliance with the data breach, data protection laws, environmental violation, a breach of major contract, and so on. So this is the first qualitative factor. The second factor is reputational risk. Reputational risk. Now, here, candidates, any issue that could damage the organization's reputation and public trust is material. And this includes ethical lapses, data privacy failures, or even misrepresentation of product information. So a reputation crisis can lead to loss of customers. It can lead to loss of brand value. It may also lead to loss of market share, which can be far more damaging than a direct financial loss. So reputation risk is also a qualitative factor. The third key factor for determining materiality is strategic impact. You check what will be the strategic impact. Strategic impact. Because a weakness in governance or a weakness in, say, compliance or failure to comply with the standard that could hinder the achievement of a key business objective is also material. So a weakness in governance or a failure to comply with the standard that can hinder the achievement of a key business objective is also material. For example, a weakness in the ICT or IT controls, a weakness in IT security control that prevents the launch of a new digital product can be considered a material issue. So we are looking at the strategic impact, which is also a key factor for determining materiality. Another key factor for determining materiality is the control environment and culture. Control, environment, and culture. Control, environment, and culture. These are issues that indicate a pervasive breakdown in the control environment or just a culture of non-compliance, which could be highly material. If the company has a culture of not complying with laws and regulations, if the company has a culture of not complying with laws and regulations, that can be considered material. Right? Because a small error might be immaterial on its own, but if it is part of a pattern that suggests a lack of management oversight or an intentional override of controls, then that can become a material issue. Number 5, we may also consider the impact on stakeholders. Impact on stakeholders. This is also a qualitative factor. Impact on stakeholders. Here you consider the impact of the potential impact on the various stakeholders, including customers, employees, investors, and so on. Another good example here is failure to meet workplace safety standards, or even if it hasn't resulted in an accident, that may still be considered a material risk. A failure to meet workplace safety standards, even if it has not resulted in an accident or an incident, that is considered a material risk. So these are 5 qualitative factors. Let's analyze the quantitative. What are the quantitative factors that determine, that help to determine materiality? Now, while these quantitative factors are less dominant than the financial audits, right? While quantitative factors may be less dominant than in financial audits, because qualitative factors are very dominant in financial audits, while they may be less dominant candidates. The quantitative factors still play a role. Okay, they may be less dominant, but they play a major role. They still play a role because they are often used as threshold to help the focus the audit team's attention. And one such qualitative factor is the potential for fines. The potential for fines and the potential for penalties. Potential for fines and penalties. This means estimating the maximum possible fine for a compliance violation. When determining materiality, the auditors may check the impact of not complying, the financial impact of fines on or penalties of failure to comply with laws or regulations. Estimating the maximum possible fine for compliance violation. And if a regulation like the Data Protection Act allows for a penalty of, say, up to 4% or 5% of annual global turnover, then a potential violation of that rule would be considered highly material. Because, in legislation currently there are always penalties and also fines that are imposed on companies that do not comply. So to determine materiality, the auditors may check if, for instance, the company is not adhering to data protection laws or even the Company Act laws or provisions. There are fines that are indicated that such companies are required to pay. So the fines, if they constitute more than 5% or thereabout, then that may be considered material. Another quantitative factor could be the cost of remediation. Cost of remediation. We may also consider the cost of remediation. This is the cost to fix a non-compliance issue. Because if the auditors are to find, if a company is not complying with certain laws, then that non-compliance may be required to be fixed. And that fixing comes at a cost. And this cost can be a material factor. So if a systematic failure requires a significant, for example, investment in new technology, training or just personnel, then the issue is considered material. So cost of remediation is also a quantitative factor. 3, you may have loss of revenue. Loss of revenue or loss of market share. Here, candidates, the potential for a compliance failure to lead, this is the potential for a compliance failure to lead to a loss of key clients or even decline in the market position, which can be a material consideration. You understand? Yes. So here, Under quantitative factors, we have the potential for fines and penalties, number 2, the cost of remediation, number 3, we have the loss of revenue. So that's all candidates for our today's lesson on materiality at the planning stage. In this lesson, we defined the meaning of materiality in the context of governance and compliance audits. We've also outlined the key factors for determining materiality. One factor is legal and regulatory impact. Number 2, reputational risk. Number 3, strategic impact. Number 4, control, environment and culture. Number 5, impact on stakeholders. Then we have the quantitative factors. One is potential for fines and penalties, the cost of remediation, and loss of revenue. So thank you for attending our today's lesson. God bless you. Bye-bye.
(2022) question 3B. Question 3B. Question 3B. It is also important to highlight what this means. Before we forget, that is your budgeted quantity. That is your actual quantity. I think all the other items we have them. Now this standard quantity in standard mix basically means it is your budgeted quantity there. So let's have that as your budgeted quantity. Your budgeted what? Quantity. Right. April 2022 question 3B. April 2022 question 3B is the question I want us to look at today. The saying, Dominion Beverages Limited makes and sells two beverage products branded Bingo and Boost. The budgeted sales profits for the year 2021 are as follows. You have your product, your sales in units, and your revenue, your cost, and your profit. Actual sales were as follows for Bingo and Boost: to 80 units with a profit of 5.3, 630 units with a profit of 2.8. The company's management is able to control the relative sales of each product through the allocation of sales effort, advertising and sales promotion expenses required. Calculate and interpret the following. Number 1, sales margin, price variance, sales margin volume variance, sales margin mix variance, your sales margin quantity variance, and your sales margin total variance. Now your total variance simply is the summation. Just indicate that. It is simply your sales price variance plus your sales volume variance. Simply the total of that. Right. Let me have this question here. You will have your products, your sales in units, that is your sales quantity in units. You have the revenue in shillings, your costs in shillings, you will have your profit in total in what? Shillings. You have two products, Bingo and Boost. How many units did you sell? 400 and 300. That means in total you sold 700. This is your budgeted. Your revenue was 8,000, 12,000, So your total revenue is 20 what? 1,000. Cost is 6,000. 11,100. 17,1. Your profit or your budgeted profit was 2,000. That is 900. So that your total profit is how much? Total budgeted profit is 2,900. Then your actual sales. Bingo was 280 units with a profit of who? With a profit of 5.3 per unit. Boost 630 units with a profit of who? $2.8 per unit. 2.8 per who? Per unit. We can start with our first variance, sales margin price variance, the first part of that question. Your sales margin price variance, you're going to say what? It is your standard what? Your actual quantity sold, your standard selling price per unit minus your actual selling price per unit. In this particular question, we had two products, the first one being who? Bingo, and the other product being who? Boosts. Being Boost. Your actual quantity sold was how much? 280 to bracket. This SP here, since it is what? For margin, they simply wanted you to realize that you're supposed to use what? A profit. You're supposed to use your what? Profit. So let's get your profit per unit. Profit per who? Per unit. You're going to take 2,000 divide by who? By 400. 900 divide by who? 300. That is 5. That is 3. So your standard profit is 5. Your actual profit here is what? 5.3. 5.3. For Boost, 630. 3 minus who? 2.8. Now let me clarify and say, in this particular question, the actual values here, we've not been given the revenues. So there is no way we can determine our what? Our selling prices here. We've only been given what? Profits. So that is what we're going to use. But in case we had been given what? The revenues here of the actual sales that were made, we would have determined this price variance by taking your actual quantity sold, your selling price, your standard selling price minus your actual selling price. But you're saying, because we don't have our what? Selling prices here, we only have our what? Profit for actual sales. There is no way we can use our what? Revenue, our profit here. Or rather, there is no way we can use our selling prices here. Okay? Now, so let's analyze this variance. 280 to bracket 5 minus 5.3. This is 84. Times 630. That is 126. Then we need to analyze whether it is favorable or adverse. This is favorable. Why? It is you selling, or this is a profit you're earning. In fact, this is a profit. You had budgeted to earn a profit of 5. You have ended up with a profit of 5.3. Favorable. This will be adverse. Why? You had budgeted to earn a profit of 3. You have ended up with a profit of 2.8. That is not good for the organization. Your profits have reduced. Therefore, that will be 42 what? Adverse. 42 adverse. Okay. The next variance that they want us to determine, number 2, is your sales margin volume variance. Sales margin volume variance. How did we say you get that? You're going to take your standard profit, budgeted quantity sold minus actual quantity done what? Sold, minus actual quantity sold. Okay. You have 2 products, Bingo and who? Boost. Your standard profit was 5 and this was 3. That is your standard profit. Your budgeted quantity sold was 400. Compare this with an actual quantity sold of how much? 280. Budgeted quantity sold was 300. Compared with an actual quantity sold of how much? 600 and what? 30. 630. So 5, 400 minus 280. This is 600. 300 minus 630. Let's see whether we have whether it is favorable or adverse. It is you selling, so that will be adverse because you've reduced your volume of sales from 400 to 280. This, you have increased your volume of sales, so that should be what? That should be favorable. That should be favorable. $390. What you're going to say is what? Favorable. That is what? Favorable. So your sales margin total variance, we will look at it, but it is basically the product of these two. We'll come to it later on. Let's go to the third part. The third part where they're asking for what? They are asking for your sales margin mix variance. Sales margin mix variance, which is your standard profit. Your actual quantity in standard who? Mix minus your actual quantity in actual mix, or simply your actual quantity, or simply your actual quantity. Okay. we need to identify our actual quantity sold is here, but you need to identify your actual quantity in standard what? Mix. So let me write this here. Let me write it here. Actual quantity in standard what? Mix. Nine, 10. Now, your actual quantity in standard mix is simply telling or simply requires that you share this actual quantity using the ratio of your standard mix, and your standard mix is here. Okay, so for bingo, you're going to take 400 over 700 times who? 900 and who? 10. 300 over 700 times who? 900 and who? 10 times 910. 520 is your actual quantity in standard mix. 390. So that you'll have sold how much? 910. So bingo, your standard profit per unit was 5 and 3. For boost, your actual quantity in standard mix 520, and this is how much? 390. Your actual quantity in actual mix is simply the actual quantity you sold, 280 and 630 and 600 and what? 30. $1,200. $720. Then see whether it is favorable or adverse. So actual, this is quantities, so this should be adverse. This should be favorable. That should be favorable. Okay. The other variance they are asking for, that is your mix variance. Part 4, they are asking for your what? Your sales margin quantity variance. Your sales margin quantity variance. Sales margin quantity variance, which will be your standard profit. Your budgeted quantity, standard what? Mix minus actual quantity in standard mix. Standard what? Mix, eh? Let's start with bingo. Boost 5 3. Your budgeted quantity, basically it's this budgeted quantity you sold or you had budgeted to sell, okay, in standard mix. So 400 300. Your actual quantity in standard mix, we've calculated it here, 520 and 390. $520 and what? 390. 400 minus 520, 600, 300 minus 390, 270. Favorable. 870, which you're going to say is what? Favorable. Now that we have calculated our sales margin quantity variance and our sales margin volume what? Variance. Let's confirm that when you take your volume, your mix variance plus your sales quantity variance, it will give you your what? Your sales margin volume variance. Eh? So we say your sales margin mix variance plus your sales margin quantity variance will give you your sales margin volume variance. Your margin mix variance is 480 adverse plus your sales margin quantity variance of 870 favorable will give you a volume variance of how much? 390 favorable. 390 favorable. Right. So those two answers should give the same. Eh? So that means we are correct. We have indeed proved that. Number 5 was your total sales variance. Total sales variance, which is the summation of your price variance plus your volume what? Variance. Plus your volume variance. Your price variance your price variance is your 42 adverse plus volume variance of 392 favorable. So therefore this should give you 348, which is what? Favorable. 348, which is favorable. Right. Those are variances of sales that we have successfully done what? Tackled. Remember, I've told you, under normal circumstances, absorption you use profit to get your what? Your volume. And marginal you use your contribution. And you know, remember, contribution is simply the difference between selling price per unit and your total variable cost. All right. This April 2022 question 3B is an exemption to that. Why? Because you have what? You have profit, you don't have the selling prices for to calculate your sales price variance. Right. And with that being said and done, in the next lesson we will talk about advanced variances of fixed overheads. So from my part, goodbye and see you in the next session. Welcome to Advanced Management Accounting. My name is Mr. Mariga, and today I want us to talk about applications of learning curve model and ABC in variance analysis, which is a topic under budgetary control and control and techniques here. Now, we were tackling cost estimation and forecasting and interpretation. We talked about learning curve, where we said that learning curve here is a method of estimation that takes the general form y is equals a b plus 1 and y bar is equals ax raised to power b, where b we said is your learning curve index, which is given by log learning curve divide that by log 2. X we said is the activity level or your output, or your output. A is a time or cost of first unit of production of production. Y is a cumulative total time or cost. Y bar is a cumulative average time. Time or cost. Remember, we said that when an employee gets used to doing something, they improve their the rate at which they produce, and that improvement rate, where they take less time or they incur less cost than the first unit they produced, is what we refer to as learning curve, is what we introduce as learning curve. And we also said that NB, your learning curve rate is simply 1 minus your improvement rate. Rate. Right, now that I've given you a brief recap of that, today we want to talk about, or I want us to introduce something on variances, where you have learning curve, where you have learning curve. And we are going to do a question of November of 2020. Let's talk about November of 2020. Question 5. Question 5. November of 2020, question 5 is a question we will tackle today, where they saying High-Tech Limited intends to launch a locally manufactured printer in the coming month of December 2020. The Research and Development Department of the company has provided the following information relating to the production of the printer. You have a selling price of 17,500 per printer. Variable production cost, you have direct materials of 800 grams at 7,500 per kg. Direct labor of 75 minutes at 3,000 shillings per hour. Variable overheads of 60% of direct labor hour. Then you have your contribution per printer. Production of the printer is scheduled to commence on 1st of December 2020. The company plans to produce and sell 3,000 printers per month. A direct material loss of 10% is expected with no resale value. The annual fixed cost attributable to the production of the printer is 60 million. The cost accrues evenly throughout the year. A learning curve effect of 95% is expected. Determine the standard labor cost for the month of December. So let's start with part 1. I want us to determine your standard labor costs. Now your standard labor cost will be determined by your standard labor hours. You multiply by your standard labor rate per hour. Your standard labor hours, you multiply by your standard labor rate per hour. Standard labor cost is given by your standard labor hour. You multiply by your standard labor rates. Which is in shillings per hour. Okay. Your standard labor rate, they've told us currently is how much? 3,000 per hour. But we need to determine our standard labor hours. Keeping in mind that we have a learning curve. So let's determine our standard labor hours. So computation of standard labor hours. Computation of standard labor hours. Your labor hours will be given by AX B plus 1, where A is the time for the first unit, and the time for the first unit is 75 minutes. 75 over 60 hours, which is 1.25, which is 1.25. Then your output that you had planned to produce is how much? 3,000 units. 3,000 printers. Then B, we know, is your learning curve index, which will be your log of learning curve, and your learning curve rate is 0.95. Divide by log 2, which is negative 0.074. Right. So let's then determine our labor cost, our labor hours first. You're producing 3,000 printers, rather The time of the first unit is 1.25, but you're producing 3000 printers. Negative 0.074 plus 1. So therefore, your total labor hours that will be used to produce the 3000 units, keeping in mind that you have a learning curve of how many? Of 95%, is that you will use 2073 hours. 2073 hours. All right. So your labor, your standard labor costs, your standard labor cost now, you're using 2073.587056 hours. You multiply that by your standard labor rate per hour, and your standard labor rate per hour was 3000. So therefore, your standard labor cost is there. Is that 6,220,761.167. All right, that is the first part. Then they're telling us part B to prepare a budget. A budget what? Statement. Budget profit statement. Let's start with your sales. Now this budget profit statement is what sometimes we refer to as an original budget or a static budget. It is a budget where you consider your activity at the beginning and your cost at the beginning. So we normally say it is a budget of budgeted cost, but for budgeted activity. So when you're determining your sales, you're going to take your budgeted selling price, you multiply that by your budgeted units sold. Your budgeted selling price was 17,500. That you multiply by your budgeted units sold, which were 3000 printers. Then you less your costs. The first cost will be the cost of direct materials, your direct material cost. And your material cost, we are using 800 grams at 7,500, but note number 3, this added and said, a direct material loss of 10% is expected with no resale value, So the 800 grams, therefore, are at 90%. What about 100%? So what will you say? Going to say 800 over 100 kgs. You multiply that by by 100. Then times what? Your cost now, your cost in kgs was 7,500 to 7,500. Okay. You multiply by your printers, which are how many? 3,000. Then all these, or let me see, not all these. Then you divide that 100 by what? 90. What have you effectively done? This is what you've done. You've said that 100 is equal to what? 90. What about 800 over who? 1,000. How much will that? That is what we've done there. Why? Because they're telling us that you have a normal loss of 10% of the material. So even if you bring 100, you're going to get what? 90. And our material, how much at 90% is what? 800 grams. 800 grams, which is 800 what? Kgs. So therefore, at 100, how much do we expect there? So you expect what? 0.88. 0.88. So this 0.88 here, which is now this working, you multiply by the price per kg, then times what? 3,000 printers. That is your material cost. I hope that is very clear why we've worked at it that way. Okay, this, I think even that is what I should write here. So let me write that so that it is very, very clear. 0.88 kgs. You multiply by who? 7,500 per kg. But you had produced how many printers? 3,000. 3,000. All right, that is clear. You then add the cost of direct labor. Cost of direct labor. And because of the learning curve effect, your labor cost, we determined it. We determined it as 62, 20, 761.16 Then you did also have variable overheads. Variable overheads, where they were saying they are 60% of direct labor. So 60% of direct labor, 167. Then lastly, you had fixed what? Overheads. Or fixed costs attributable. For the whole year was 60 million, but you want only for the month of December. So you're going to take 60 million. You divide that by how many months? 12 months. You divide that by 12 months. Two. This is 20 million. This is 37. 324. 56.7. And lastly, your fixed overhead cost is 5 million. So your budgeted profits. This is 556. 556. All right. That is your budget. That is how you apply learning curve as far as variances is concerned. The next part of that question, where they're telling us to reconcile, we will do that in the next lesson, where I will introduce 3 items or 2 items. Number 1, I will introduce operating variances. I will also introduce planning what? Variances. Alright, those 2 things. But for these 2 to exist, you must have what we refer to as revised standards. You must have revised what? Standards. For those 2 to be there, but we're going to talk about them in the next what? Lesson. In the next lesson. So what so far as we've been talking about is conventional variances. Conventional variances, or you simply compare standard or what? Original with actual. You're operating here, you compare your revised and your actual. This one, planning, is your standard and your actual, but we'll talk about that in the next lesson in more detail. So from me, goodbye and see you next time.
I'm glad to welcome you back to the lesson. Today we continue with the subject governance and compliance audit. Our focus today is on levels of assurance, determining the level of assurance, which is a very critical step in the planning phase of the governance and compliance audit, because it directly impacts the scope, the audit procedures, the amount of evidence required, and also the nature of the final report. And unlike the financial audits, where the standard is often reasonable assurance, governance and compliance audits may have more flexibility in the level of assurance that is sought. And the level of assurance candidates is just a measure of the confidence that the audit team provides to stakeholders regarding the subject matter. Assurance comes from the word assure, to assure. When the auditors examine the records, the objective is to provide assurance on the subject matter and its spectrum, not a binary choice, and it's not a binary choice, but it's just a professional judgment call based on the auditor's objectives, risks, and also stakeholder expectations. So when conducting a governance and compliance audit, just like the financial audits, the auditors are required to provide some level of assurance. And the levels of assurance may be categorized into 3. 1 is the reasonable assurance. Number 2 is the limited assurance, and no assurance. That is what we are going to study in our today's lesson. Levels of assurance. There are generally 3 levels of assurance that can be provided in a governance and compliance audit. And the first level, I've mentioned it, which is a reasonable assurance. A reasonable assurance is a high level assurance, okay? But it's not absolute assurance. And here, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence. But that degree of confidence is not 100% certainty. Okay? But it is just, it indicates what we call materiality compliant with the criteria that is established. You understand? It is a high level assurance. A reasonable assurance is a high level assurance. And this level requires extensive and rigorous procedures. The audit team must perform detailed testing. It has to do what we call substantive procedures. It has to verify controls and compliance activities. And it often includes a combination of inquiries. The auditors have to make inquiries. The auditors have to inspect documents. They have to observe processes and also reperform procedures. You understand? For you to provide a high level assurance, for the auditor to provide a reasonable assurance, the auditor has to carry out substantive procedures. And the final report provides what we call a positive opinion. It provides a positive opinion that in the auditor's judgment, the organization's controls or compliance activities are effective and free from material non-compliance. The auditor can only give that opinion after conducting thorough investigation, after ensuring that he's done detailed testing, after the auditor has verified controls and compliance activities. It is only then that the auditor can give a high level assurance or a reasonable assurance. You understand? And this level candidate is chosen for high risk areas where non-compliance would have a severe impact. Examples could include audits required by law or regulation. It could be audits of critical financial controls or data security systems. Another example could be audits where there is a high potential for reputational damage or significant financial penalties. You understand? Yes, you need to understand, candidates, that when called upon to carry out a governance and compliance audit, as an auditor, you may be required at the end of the day to provide assurance to the stakeholders. And that assurance can be categorized into three: reasonable assurance, limited assurance, and no assurance. We've defined reasonable assurance as high level assurance, but it's not absolute assurance. We say that in a reasonable assurance, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence that the subject matter is materially compliant. And we'll give an example. It could be audits that are required by law or audits of critical financial controls. It could be audits where there is a high potential for reputational damage. Then there is a second level of assurance, which is a limited assurance. On the other hand, what does it mean? This is a moderate or less reasonable assurance. It's a moderate assurance. And the auditor here has to perform fewer procedures and therefore provides a lower level of assurance because he has conducted fewer procedures. You understand? And the conclusion is often negative. Here we said the opinion or conclusion is positive. Here the conclusion or opinion is negative. What do we mean by negative? Negative. The opinion here is negative. It is a negative one, stating that based on the work performed, nothing has come to our attention. That is what the report will read in a limited assurance. Based on the work performed, nothing has come to our attention that causes us to believe there is a material non-compliance or significant control weakness. Okay? Nothing has come to our attention. That is being negative. Nothing has come to attention. Having carried out fewer procedures, nothing has come to our attention that causes us to believe that there is material, that there is material non-compliance or significant control weakness. And unlike reasonable assurance, procedures are less, procedures are fewer, procedures are less extensive than a reasonable assurance engagement. And here the auditors often rely on inquiries. Okay? They do not carry out substantive procedures. They rely on inquiries, on just interviewing the personnel, carrying out analytical reviews, and so on. Okay? And high-level inspections rather than detailed testing of transactions or controls. And the focus is on plausibility rather than detailed verification. In limited assurance engagement, there is limited engagement. There is limited. It's limited. Okay? Testing is limited. And that's why the degree of assurance is low. And the final report provides a limited opinion, which is a less definitive statement than a positive one. It is not as definitive as a positive conclusion or a positive opinion. And this level of candidate is often used for areas of lower risk. If there are areas of lower risk of non-compliance, you apply this level of assurance. But if it is a high risk area, then you have to do substantive testing in order to come up with a reasonable assurance. Okay? Or when there is a quick or cost-effective review that is needed. It can also be good when starting. It can be a good, let me put it, it can also be a good starting point for a new audit area or an immature compliance program. And examples of limited assurance could be a review of an organization's, say, environmental and social activities. Okay? A review of an organization's maybe first-time environmental or social governance. Or just another example could be an initial assessment of a new business process or internal management requested reviews of routine operations. Is that clear, candidates? That is limited assurance. Then we have the third level, no assurance. There are times when no assurance is required. 3, no assurance. no assurance. In no assurance here, we are referring to the agreed upon procedures. Agreed upon. Here, the audit team performs a specific set of procedures agreed upon in advance with the client, and no opinion or conclusion is required. No required. The auditor agrees with the client to carry out certain procedures without having to provide any opinion on the work that has been done. And the report simply lists the procedures performed and the factual findings. The scope and procedures could be narrowly defined and agreed upon by all parties, and there is no independent judgment or opinion expressed by the auditor. And in a no assurance level kind of engagement, the report states that the report states the factual findings. Okay, the report will just state the factual findings. The report may just state the factual findings. Okay, the auditors may, for example, say, we observed X number of instances where policy was not followed. Okay, and such candidates example of assurance is appropriate. Is appropriate, for example, for specific or targeted reviews where management needs a quick check on a particular area without a full audit. Maybe the management will need to have an understanding of what is going on, all right, and so on. So here, no conclusion is required. Understand? Yes. Now, in closing, let's briefly discuss factors determining level of assurance. Factors determining level of assurance. What are the factors that may determine the level of assurance? Now, the decision on which level of assurance to seek is a strategic one that is made in the planning phase, often in consultation with the client's committee and senior management. And there are various factors that will determine whether the auditors will provide a reasonable assurance, limited assurance, or no assurance at all. And one such factor is risk. You recall when discussing the reasonable assurance, we say that this kind of engagement is carried out on high risk areas. The level of inherent and residual risk in the audited areas is the most important factor. High risk areas require a high level of assurance, and low risk areas may require limited assurance. So risk is a factor. The second factor is stakeholder expectations. Expectations of the stakeholders. What level of assurance do stakeholders expect or require? And these stakeholders could be the board, the regulators, the investors, and so on. For example, a company preparing for public offering may need a high level of assurance than a privately held company. Number 3 is cost or resources. Cost or resources. A reasonable assurance engagement requires significantly more time, more resources, and a larger budget than a limited assurance review. Why? Because to carry out reasonable assurance, to provide reasonable assurance, we say that substantive testings must be done, detailed tests must be carried out, and to do such kind of testing, the auditors require a high budget. Number 4, Maturity of the control environment. Maturity of the control environment is also a factor that will determine the level of assurance. If an organization's controls and processes are new or immature, it may be more practical to start with a limited assurance review in order to identify major gaps before investing in a full reasonable assurance audit. That's a fourth factor. Now, the fifth factor is regulatory requirements. Regulations. Some laws or regulations explicitly require a specific level of assurance. The regulators may insist that certain audits be performed. So candidates, that's all. For our today's lesson on levels of assurance, which is a high level assurance. Then we have limited assurance level, which is a low level assurance. Then there is no assurance, agreed upon procedures. In a reasonable assurance, a positive conclusion is made. In a limited assurance, a negative conclusion is made. Where there is no assurance required, no opinion or conclusion is required. Then in this lesson, we've discussed 5 factors that determine the level of assurance. The first and the most important factor is risk. Number 2, stakeholder expectation. Number 3, we have cost and resources, maturity of control environment, and regulatory requirements. So it's important to consider these factors, and by carefully considering these factors, the audit team can determine the appropriate level of assurance, ensuring that the audit provides the right amount of confidence and the right amount of value without being unnecessarily burdensome or unnecessarily costly. It's important to consider these factors such that when the audit is carried out, such an audit is not a burden to the client or a burden to the audit team. Thank you. God bless you. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Mariga, and I'll be teaching you Advanced Management Accounting. So today we are going to continue with the topic we had started previously or in previous sessions on planning and decision making, where we had talked about cost volume profit analysis under conditions of uncertainty. Specific items we discussed during the previous sessions is number 1 is cost volume profit uncertainty model using expected value approach, using simulation approach. So today we will discuss using sensitivity analysis and maybe using statistical analysis. But let's start using sensitivity analysis. So C is sensitivity analysis. Now, sensitivity analysis here is basically where you want to measure or you want to identify or to determine the percentage change in factors affecting profits as a reason of changes in what? In profit. Let me explain that. You want to determine how sensitive one of the profit is as a result of changes in what? One of the factors affecting what? Profit. And we can have an illustration given Your selling price per unit is 200. Your variable cost per unit is 50. Your fixed cost in total is 200,000. And your current sales is how much? 2,000 units. Then required, can say required, compute the percentage change in each input, variable, in each input variable, which will cause profit to drop to what? To zero. So determine the percentage change of each variable which will cause the profit to drop to what? To zero. We can start by determining that and realizing that your profit, which we denoted as P, as pi rather, is P minus V. You multiply by your units minus your what? Fixed costs. Minus your fixed cost. So you want to analyze what change will the selling price change by for the profit to be zero? What percentage change will the variable cost change by to give you a profit of zero? The fixed cost and also the units. Let's start with A, percentage change in what? In P, in selling price P per unit. Remember, P means your selling price per unit. Your current profit is going to be zero. You have to determine a new selling price. Your variable cost is 50. Your units sold are not going to change, will be how much? 2,000 units minus a fixed cost of 200,000 minus a fixed cost of 200 what? 1,000. So this will be 200,000 is equals to 2,000 P minus 10. That is what? That will be your what? Your equation. That will be your equation. What we've done, we've simply taken 200 to the other side, then opened this bracket by taking 2,000 by P, that is 2,000 P, then 50 by 2,000, that should be 100,000. Then you're going to say 300,000 is equals to 2,000 P. So that means your new selling price for it to result in a profit of how much? Zero, means your selling price will be what? 150. But remember, we want our percentage change. So you're going to take the current or your new selling price, which is how much? 150. You subtract your original selling price of 200, divide by what? Original selling price of 200. Then you multiply by who? 100%. You multiply by 100%. So it basically means that for your profit to fall to zero, the selling price will need to reduce by what percent? 25%, if all the other factors are not being done what? Affected. That is a percentage change in what? Selling price. Let us also do the same for variable cost. Percentage change in variable who? Cost. Again, you want your profit to be zero. All the other factors apart from what? Variable cost will be the same. Your original selling price is 200. You want a new variable cost. How many units are you selling? You're selling 2,000. And your fixed cost is still originally how much? 200,000. 200,000 is equals to 2,000 by 200. That will be 400,000 is equals to 200,000 or 2,000 of what? V. So 200,000, if you work it out, is equals to what? 2,000. So your variable cost will be how much? 100. So for your for your variable cost to give you a profit of 0, it will need to be set at what? 100. So let's determine our percentage what? Change. Your percentage change, which will be your original, or rather your new 100 minus the original, which was how much? 50. Then divide by the original, then times what? 100 times 100. So therefore that is 50%. 50%, which basically means that your variable cost will have to do what? To increase by 50% for the cost to do what? For the cost to have an impact of making the profit to be what? 0, of making the profit to be 0. That is your variable cost. Then the other factor that we want to analyze, say percentage change in what? Units. So percentage change in what? Units. So we want to identify what change will result in profit being what? 0. What change in units will result in profit being 0. So you will say 0 is equal to, your selling price is 200, your variable cost is 50. The units you don't know, but you know your fixed cost is how much? 200,000. So therefore your units will be 200,000 divided by who? 150. Divide by 150. 33.33 units. So for the company to gain a profit of 0, which is where your revenue and your cost are equal, you have to sell how many units? 1333.33. 1333.33. Let's now identify the percentage what? Change. Your new units minus your original units, divide by your original units, times 100%, times 100%. So we want to take the percentage change, percent. So it basically means what? That your units will have to fall by 33.33% for the profit to be what? 0. Let's analyze your fixed costs. Percentage change in fixed costs. Your percentage change in fixed costs. Again, you want a profit of 0. Your selling price will be your as original 200. A variable cost of 50. Your units are 2,000, but you know you don't have your what? Fixed cost. So therefore, your fixed cost will be what? 150 by what? 2,000. When you work that one out, that will give you 300 what? 1,000. What you've simply done, we've taken this fixed cost to the other side. Then open that bracket. Alright, so your percentage change in fixed costs will be your new fixed costs minus your original fixed costs, divide by your original fixed costs, times 100. So it basically means that your fixed cost will have to do what? To change by 50%, or it has to increase by 50% for the selling price, or for the profit to be equal to what? To 0. To be equal to 0. That is what we refer to as sensitivity analysis. Simply analyzing the percentage change in one variable as a result of another variable. All right. Sensitivity analysis is that. Let's go to the next method known as statistical analysis. The next method is what we are referring to as statistical analysis. Statistical analysis. Now, statistical analysis here simply involves using statistical measures to determine how cost volume profit is reacting, or how a product is reacting. And the following are the common measures used. The measures of statistics. The first measure of statistical analysis that we could use to analyze cost volume profit under conditions of uncertainty is what we refer to as expected value. Your expected value, which we have already even covered here, and your expected value, we said, how do you determine your expected value? You simply take X, you multiply by probability. It could also be given by the summation of X divided by N. So for the second formula to be used, you only use it when you don't have what? Probability. The second measure of statistical analysis of CVP under conditions of uncertainty is what we refer to as standard deviation. Standard deviation, which you denote as that. So the standard deviation here is given by the summation of probability X minus the expected value. You do what? You square X minus the expected value, you square. In case you don't have probability, this is the formula you use. N minus 1. N minus 1, where N simply represents the number of observations. N is the number of what? Observations. The third statistical measure is coefficient of variation. Which you simply denote as CV. So CV, you simply say it is your standard deviation divided by your expected value. Your standard deviation divided by your expected value. Your standard deviation by your expected value. We can have an illustration. To guide us on statistical measures of CVP. You can have an illustration that we will use to do this question and to illustrate statistical measures of CVP. Statistical measures of CVP. And the illustration will read as follows. The illustration will read as follows. It will read as follows. A company is considering mutually exclusive products. And A and B. The following information has been provided. has been provided. We can start with product A. Product A, you'll have your probability and your profit in shillings. Your probability and your profit 0.1, 0.7 and 0.2. 10,000, 20,000 and 30,000. Product B, product B, have your probability and your profit in shillings. Zero 0.4, 0.5, 0.1, 10,000, 20,000 and 30,000. Then the requirement here, using statistical measures of CVP, advise the management of a company, advise the management on the product to produce, on the product to produce, on the product to produce, on the product to produce. So they want us to analyze, using the statistical measures, which of our two products, whether A and B, we should do what? Produce. We should produce. We can start by getting your expected value. And we know that is given by your probability times who? Times the profit, or the variable. In this case, the variable is your profit. So 0.1 by 10,000, 0.7 by 20,000, 0.2 by 30,000. Your expected profit for B, for product B, 0.4 by 10,000, 0.5 by 20,000, 0.1 by 30,000. We need to determine this. This is 1,000. That is 14,000. And that is 6,000. So that the expected value there will be what? 21,000. That must be 4,000, 10,000, 3,000. So that is 17,000. So using the expected value, product A, product B, and your advice. Product A, product B, and your who? Your advice. So using the expected value approach, using the expected value approach, product A had an expected value of 21. Product B had an expected profit of 17. So the product you want to produce in this case will be the one with the highest expected profit, which will be product A. So you advise them to produce product what? A. Let's determine our standard deviation. So introduce your probability x minus x bar, you do what? You square. 0.1, 10,000. Your expected is 21,000. Then what do? We square. 0.7, 20,000 minus unexpected of 21,000. We do what? We square. 0.2, 30,000 minus unexpected of 21 squared. Then what do? We square. The same case is true here. That is how you get your deviation. Your probability is 0.4. 10,000 minus unexpected of 17,000 square. 0.5, 20,000 minus unexpected of 17,000, but remember to do what? To square. 0.1, 30,000 minus unexpected of who? 17,000. And what do? You square. You square that. And once you're done squaring, you must get your who? Total. So let's do this together. 10,000 minus 21,000 squared plus 0.7, 20,000 minus 21,000. What do? You square plus 0.2, 30,000 minus 21,000 squared. But remember, you must confirm your answer so that you see whether it is what? Accurate. This, I believe, should be 29 what? Million. 29 million. Then let's talk about the other products. B. Let's determine this the variation there of product B. We're still comparing the actual minus your expected, then you multiply by probability of each. That is 41,000. But again, we've said, please make sure you confirm. Please make sure you confirm for accuracy purposes so that you don't make a mistake. Please always confirm your answer so that you don't make a what? A mistake. All right. Now the standard deviation. Standard deviation. So there, what do? So the standard deviation of 29 million. And the standard deviation of who? Of 41 million, or the rather square root of 41 million. This I can see is 6403.12. This is 5385.16. So you're going to tell them to use product what? A. Why? Because it is the one with the least standard deviation. Then your coefficient of variation, you're going to take 5385.16 divide by 21,000. 0.256, then 6403.12 divide by who? 17,000. 0.377. And here you look at the one with the least coefficient of variation. which in this case you're going to say it is product what? A. Product A. Why product A? One of the measures of risk is coefficient of variation. One of the measures of risk is coefficient of variation. So you look at the one with what? With the lowest risk. With the lowest risk. And those are what we refer to as statistical measures or statistical analysis of CVP under conditions of uncertainty, under conditions of uncertainty. So this, we are done with it. Remember, we're going one at a time. One at a time. Let's now talk about number E, or the fifth method of dealing with CVP where you are uncertain, which is probability tree diagram. Probability tree diagram. So you will allow me to do away with this, your probability tree diagram. Your probability tree diagram, is where you simply draw a tree diagram, almost similar to when you're dealing with probability trees. From your mathematics, you must have done probabilities. So we'll be drawing a similar tree. And for us to be able to draw that or to illustrate that, there are certain items we must be given. One of the items that you must be given is your probability. You must be given your probability. And you must be given your variables. You must be given your probabilities and your what? Variables. Your variables here may be labor cost, maybe material cost, maybe direct expenses, variable overheads, maybe the variable cost, maybe the fixed cost, maybe the units to be produced and sold. But they must give you some variable that you're going to represent in your tree diagram so that it can help you to get a decision. For example, if they're asking you to draw a tree diagram to determine your contribution, you know your contribution is the difference between your selling price and your variable cost. So one of the items that they must provide is your selling price. The other item they must provide is your variable cost. They must also provide your what? Quantity sold. If they ask you to represent or to determine profit using probability distribution again, they will give you selling price that they must provide and the probabilities. They must also give you what? Variable cost with the probabilities, the units sold, the fixed cost. So we're saying when you're dealing with a probability tree diagram, there is some certain information you must be done what? Given that is uncertain, and that is why you're going to be drawing a what? A tree diagram. And I want us to look at an illustration on the same, on a tree diagram. And the question I want us to talk about specifically is on April 2024. Let's go to April 2024. April 2024. The question we want to tackle is question 2A. And the company name is what? Joe Mwinzi. That is the name of that company. Joe Mwinzi, the management accountant of Vera Enterprises that makes and sells products alloy, has made the following estimates. You have your sales, you have three conditions, which is the worst, the most likely, and the best. You have your probability of the sales. You also have your variable cost under the conditions that are worst, most likely, and best. You have your costs or variable cost per unit under those conditions. And you also have the probability of variable cost under those conditions. Additional information. The selling price of alloy product is 1,000 per unit. Fixed cost attributable to alloy product is 24 million. Vera Enterprises intends to achieve a target profit of 6 million. Using a probability tree, compute the expected profit of Vera Enterprises. Number 2, compute the probability that Vera Enterprises will fail to break even. Number 3, determine the probability that Vera Enterprises will not achieve the target profit. The target profit. So they're telling us to determine your expected profit using your tree what? Diagram. Remember, from the previous working, we know how do you get expected values? You simply take your variable, you multiply by your what? Probability. So even in this particular circumstance, to get our expected profit, we will take our profit, you multiply by your what? Probability. But you know, how do you determine your profit, class? Your profit, we've talked about it so many times. It is determined by your selling price minus variable cost. You multiply by your units, and then you subtract your what? Fixed cost. You subtract your fixed cost. They are telling us that the selling price is 100. Your variable cost has been provided, and various costs have been provided with various what? Probabilities. So it basically means you are uncertain of the true cost of the variable cost. The units to be sold after production, you have been given under various conditions, and they are probabilities. And so this is how you're going to draw this tree diagram. This is how you're going to draw this tree diagram. Let's start by determining the units. There, there, and there. Your units, you have 45,000 units with a probability of 0.3, and those are the worst conditions. That is worst condition. The next condition is when it is most likely. Most likely. And most likely, your probability is 0.6. Then you have the best condition. The best condition, you have a probability of 0.1. Of 0.1. 0.1. How many units are these of most likely? 50,000. And best conditions was how much? 55,000 units. 55,000 what? Units. We have represented the units to be produced and sold. So these are your who? Units. These are your units. The other uncertain item that we don't know about is your variable costs. Your variable what? Costs. And your variable cost, we will have it in 3 market conditions. 3 market conditions. Let's draw it nicely. 3 market conditions. The first market condition is 0.3, which is what? The worst. So let me write this here, the worst. The worst condition with a probability of 0.3, and your cost is 350. Most likely is the next market condition. With a price with a probability of 0.5, but a cost of how much? 400. You have the best condition with the probability of 0.1 with the price of how much? 550. You repeat this. Worst, your probability is 0.3. Most likely, your probability is 0.55. The best condition, your probability is 0.15. 0.15. Then we also need to analyze what? Worst, 0.3. Most likely, 0.55. The best is 0.15. Your prices are 350, 400, 550, 350, 400, 550. That is your variable costs. These are the units, so these are your variable costs. Very important that you capture that. That is your variable cost there. Okay? Then we can then determine your contribution margin. Your contribution margin multiplied by the units will give us what we refer to as total contribution. Remember, how do you get your contribution margin? It is simply the difference between your selling price, and remember, your selling price was set as what? 1,000. Your selling price was set at 1,000. So to get your contribution margin, you simply take your selling price minus your variable cost. Minus your variable cost. And how will that be? You're going to take 1,000 minus 350. 1,000 minus 350. 1,000 minus 350. You'll say 1,000 minus 350. Then you multiply by the units. And how many units were you selling? 45,000. So please confirm that that is 45 million times 650. This is 29 to 50,000. So my values are in thousands. My values are in thousands. Then again, determine your contribution margin by taking your selling price 1,000 minus 400. I believe now you have understood that. Times your units, and your units were 45,000. 1,000 minus 550. How many units again are you selling? 45,000. 1,000 minus 350. Yeah, your selling price is not changing. You multiply by who? Your units now, for the most likely scenario, are 50,000. 1,000 minus 400. Again, your units are 50,000. 1,000 minus 550. You multiply by 50,000. That will give you your contribution. 1,000 minus 350. Your units under the best scenario is selling 55,000. 1,000 minus 400 by who? By 55,000. 1,000 minus 550 by who? By 55. Then we now get our who? totals. We then now get our who? Totals. We need to get our totals. We get our totals. 600 by 45,000. That must be 27 million. 1,000 minus 550 by 45,000. That must be 20 to 50,000 times 50,000. That must be 32,500. That must be 30 million. 1,000 minus 550 by 50,000. That is 22,500. 1,000 minus 350 times 55,000. 35,750 million. 1,000 minus 400 by 55 is 33 what? Million. 1,000 minus 550 times 55,000. 24,750,000. That will give you your who? Contribution. That will give you your total who? Contribution, which is your contribution margin times your units. Then you then subtract your who? Fixed costs. So let's have our who? Fixed costs. And I will have my fixed cost in thousands of what? Shillings. So you need to indicate that. Your fixed cost, what were they saying? Note number 2. The fixed cost attributable will be how much? 24 million. So this should give you 24,000. 24,000. 24,000. 24 again. 24. 24. 24. 24. And lastly who? 24. Now with that, we then need to get our who? Profit. Remember they wanted us to get our what? Expected profit, which we know. For us to get our expected profit, we need to get our profit. We multiply by our probability. So let's start by getting our profit. 29 to 50, which is your contribution, minus your fixed cost of 24 million. This will be 52.50. 27 million minus 24 million. That will give you 3 million. 20 to 50 minus 24 million. That will give you a negative profit of 37.50. 32,500 minus 24 million. That is 8,500. That is 6 million. 22,500. Is that 1,500? Yes, it is. Minus 24 is 1,500. 35,750 minus 24 million. That must be 11,750. 33 million minus 24 million. That is 9,000. 9,000 or 9 million. 24,750 minus 24 million. That is how much? 750. We then will introduce our joint probability. Our joint probability, which we simply denote as JPO. Why are we doing that? We are doing that so that we now take our profit by our joint probability to get our expected profit. Our expected profit. Your joint probability will simply take the probability of units, you multiply by the probability of your variable cost. For example, 0.3 by 0.9, 0.3 by 0, it should be 0.3, eh? The other one is what? 0.3. You multiply by who? 0.55. I'm indicating this because it is necessary so that you together 0.3 by 0.15. Very nice. Must indicate this. 0.6 by 0.3. 0.6 you multiply by who? 0.55. That was 0.6 by 0.55. 0.6 by 0.15. Best 0.1 by 0.3. 0.1 by 0.5. 0.1 by 0.15. Sorry about that. We then get our joint probabilities now. Our joint probabilities. 0.3 by 0.3 is 0.09. Then 0.3 by 0.55 is 0.165. 0.3 times 0.15, 0.045. 0.6 by 0.3, 0.18. 0.6 by 0.55, 0.33. 0.6 by 0.15, 0.09. 0.1 by 0.33, 0.30. 0.03. 0.055, 0.015. Wonderful. Let's then get our expected profit. Our expected profit by taking your probability, you multiply by your who? Profit. Your probability, you multiply by your profit. So 5250, and this was in thousands of shillings. Remember that is in thousands of shillings. 5250 by 0.09. 5250 by 0.09. That is 472.5. 3000 by 0.165, 495. 3750 by 0.045. This will be 168.75. 8500 by 0.18. 1530. It is very, very necessary. As much as it looks exhausting and very involving, you need to do this. 1500 by 0.09. 130. 11750 by who? 0.03. 352.5, 9,055, 495, 750 by 0.015, 11.25. Once you've gotten the product of your probabilities